Before I get started, we were out a little earlier, just me and the kids. And on the way back home, an old jam came on. Whoop, there it is. Holla. Whoop, there it is. My kids were jamming. They were jamming to that old song. That's funny, because usually they're quick to, oh, turn it off. What is that? Whoa, come on. Can Daddy, Mommy listen to something we used to jam to back then? You guys don't get to hog the radio. Come on. My car, son. Or daughter. Anyways. Zero hedge. Get ready for QT1. A first look at the Fed's hidden policy. And this has to do with, remember, we got to unwind. We got to unwind the balance sheet. $4.5 trillion. We've never had a balance sheet of that size ever, even kind of. Not even close. Not even remotely close. We got to start unwinding, baby, while raising rates, right? The recipe for a disastrous economic downturn. But let's see what we got here. Authored by James Rickards via the Daily Reckoning. The Federal Reserve is now setting out on a new path for quantitative tightening. Oh, QT1. After 9 years of unconventional quantitative easing, or QE, policy. It is the evil twin of QE, which was used to ease monetary conditions when interest rates were already zero. First, it is important to examine QE and QT in a broader context of the Fed's overall policy toolkit. Understanding the many tools the Fed has, which of them they're using, and what the impacts are will allow you to distinguish between what the Fed thinks versus what actually happens. We have a heavily manipulated system. For years, if not decades, monetary policy has been flipping back and forth between how the economy actually works and what the Fed believes actually works, or what they believe works. QE, QE was a policy of printing money by buying securities from primary dealers and to ease monetary conditions when interest rates were at zero. QT takes a different approach. In QT, the Fed will sell securities to the primary dealers, take the money, and make it disappear. Now, I've got a question before I move on. The quote-unquote primary dealers, do they have enormous amounts of funds to pull back $4.5 trillion? I mean, who are these primary dealers? This is an attempt to ultimately reduce the money supply and implement a policy of tightening money. There's a bit of a twist to that selling. Today, the Fed's balance sheet stands at $4.5 trillion. It started at around $800 billion in 2008 and has increased over 5 times since that crisis. Now that, or not that, but now they're going to try to get the balance sheet back to normal levels. But I want you to remember something. Ben Bernanke came out recently. Yes, old Ben. Ben Kenobi. Or that's Obi-Wan Kenobi. Ben. What? Wasn't it Ben? Ben Bernanke came out. Would it really be a bad thing if we just kept the balance sheet up there and used the balance sheet, and maybe we should not unwind? That was kind of, he had an argument of why maybe we shouldn't unwind, just let it go. Use it as a tool. But who knows? Simultaneously, the Fed wants to get interest rates back to normal. The Taylor rule, which is one of the most accepted normative rules, indicates that interest rates should be 2.5%. As of June 14th, the Fed raised rates by going up 1% total, with a new target range of 1 to 1.25%. The Fed hiked rates not because it believes the economy is getting stronger, but because it's desperately trying to catch up before the next crisis. They are now trying to normalize the balance sheet. Under the Taylor rule, a normal balance sheet at the current expansion rate could be expected to be $2.5 trillion. That means you have to take $2 trillion of money and make it disappear. They can do that by selling securities, but the Fed believes that the market's too fragile. Or as they said in the Christmas story, fragile. Must be Italian. No, honey, I think that says fragile. Oh. Instead, they're going to leave securities on the balance sheet and allow them to mature. Think of this as the Fed putting QE in reverse. The Fed has been rolling over the balance sheet to keep it at $4.5 trillion, of course. You'll be hearing more about quantitative tightening in the weeks and months ahead for 2017. What quantitative tightening means is that they're going to stop rolling it over. That means as securities mature and the Treasury sends out money they're not going to buy, replenish, or buy more, this should cause the balance sheet to shrink and the money supply to be reduced. The Fed is not going to do it all at once. I want to let you know, though, every time this has happened in history, recession/depression took place. Just an FYI. Money tightening, that's what they did in the first Great Depression. The real news the market will continue watching at the Fed and its Federal Open Market Committee, or FOMC, will be quantitative tightening, or QT. While the Fed might not use the exact QT language, they will intend to reduce rollovers of long-term asset purchases. The same way they tapered QE, they're going to taper QT. This time, however, they're going to taper upward, meaning they're going to go from $10 billion a month not being rolled over to 20, 30 billion, etc. Quantitative tightening in Wall Street. Eventually, the amount of securities they don't roll over will go up until the balance sheet, controlled by the Fed, comes down to the targeted figure. The projection is that it could take 10 years to achieve. A decade. Wow. The problem is we might not make it that far before the entire system collapses. We're in a new reality. By raising rates and leaving open the possibility of further increases of all the monetary actions being taken are tightening the economy. The Fed's QT policy that aims to tighten monetary conditions, reduce the money supply, and increase interest rates will cause the economy to hit a wall. The decision by the Fed to not purchase new bonds will be just as detrimental to tightening of the economy as raising interest rates. The economy is slowing. Even without any action, retail sales, real incomes, auto sales, and even labor force participation are all declining. Every important economic indicator shows that the U.S. economy is slowing right now, which, as you know, 2017, I've been covering left and right. When you add in rate hikes and QT, we may very well be in a recession by this time next year. The Fed is tightening into weakness. Because they're getting ready for a potential recession where they'll have to cut yet again, then it's back to QE. You could call that QE4 or QE1 Part 2. The point is that the Fed has essentially trapped itself into a state of perpetual manipulation. This is what Wall Street doesn't understand. It's still operating from outdated assumptions on how the business cycle works. Those on Wall Street continue to have models that build according to the old reality, not the new one. The reality is that the market is fundamentally set up for a fall. The fact is that the Fed has no idea what it is doing. I would expect a severe stock market correction coming sooner rather than later. While the Fed may act to try and bail out the stock market and Wall Street again, they're not going to be bailing out you and me. Now is the time to increase your allocations to cash, gold, silver, and U.S. Treasuries, he says. I'm going to talk about that in a second. Preparing now will offer the best insurance position in the wake of the coming crash. There's a few things in there like he said. Cash on hand, get into cash. I'm okay with that. But I'm really okay with him saying also gold and silver. Not real fond of U.S. Treasuries. No, because the money I'd be putting in the Treasuries and the money I'd be having on the side in cash, I would be dumping into cryptocurrencies, flipping them like I've been telling you about for the last freaking month. Hopefully making a lot of people fortunes from the emails I'm getting. I'm doing a good job in a combination with Cliff High's work, because I can't just do it. It's not me by myself. I got to give him full credit. And then take that profit, even some of it, even a smidgen of it, because there's probably a good size of it, and go to sdbullion.com and buy some freaking silver. If you go there, sdbullion.com/jsnip4, there is a special discount code for a 10-ounce bar at spot price. For new customers only, they said. The link to that is in my description box of this video. And matter of fact, every single video. And also for my new subscribers, newer, when I do these videos every day, in the description box, the topmost thing you'll see, the first thing you should see in the description box is a link that says today's playlist. I do 3-4 videos a day now. I was stuck on 3. Now it seems I can't get away from doing 4. And I just go, they'll play one by one autoplay, so you don't have to like bounce around. Just a little tip there for you. So yeah, take some profit, take some cash, whatever, get yourself some metals. Like I said, I've got my stash. I hang on to my stash as far as metals, and I'm a big silver guy specifically. But I'm, you know, I got some cash inside for these cryptos, and I've done that. If you know, and I'm going to say this now, you probably never would have expected me to say this. If I only had like $1,000 to my name, I didn't have silver, I didn't have any kind of asset, I had nothing, no asset, nothing. Would I get into silver or gold right now with $1,000, or would I get into these cryptos? The answer, shockingly, I would get into the cryptos. Again, make a couple of plays, make a handsome profit. Your $1,000 is way back in your bank account now. You're happy there. You got a bunch more in profit. Take some of that profit and then buy that silver. I would never say that type of thing. That would never come out of my mouth unless I felt that strongly about these things. You know me, if anyone followed me for a long time. But this is an opportunity to flip something, make a massive profit, and then go take the profit and buy some metals. That's like the big rainy day fund, the metals, right? And when they start going up, there's going to be a stampede for those things. So you kind of want to do this as soon as you can. But anyways, that's it. On to the next one. Take care, my friends.